Welcome everybody, and thank you for joining today's webinar. I'm Ben Faust from Avalara, and today we will be discussing the massive opportunity that presents the United States for European businesses either looking to sell in this market, already selling there, already established. And some of the things we're going to be covering today is what to think about, what the implications will be when you're selling, and obviously trying to provide some tips and any advice and what we see from our customers in our experience. I'm also joined by Ben Troch from IMS today. We've been partnered for a number of years already. It's always a pleasure. Would you like to introduce yourself, please?
Yes, so my name is Ben Troch. I work for IMS. We're a US accounting, tax and consulting firm, and we mainly assist European companies that are doing business in the US. Our main office is in Chicago, where I also lived for a few years. But we also have people in Europe to cover the time difference because the main contacts that we speak to are based in Europe. So then you don't have to wait until the afternoon until someone is available. And I'm now based in Brussels. I'm responsible for the Benelux, so Belgium, Netherlands, and Luxembourg. And I'm excited to be here to talk about some of the things that European companies should consider when doing business in the US.
Fantastic. Yeah, I mean, you're certainly always a good help to our customers, so thank you. And just before we do get started, a little bit about Avalara. So we are a global tax technology company. We provide a variety of software and services and solutions to businesses of all shapes and sizes. I mean, we love taxes. Our passion is really to make lives easier and to help automate any tax compliance issues that any businesses might be having or any concerns. Essentially helping businesses to just focus on the things that they do and that they enjoy doing, growing the business, keeping their customers happy, etc. We have more than 41,000 customers from over 75 countries. We have full range of duty and tax coverage in over 190 countries, and we have over 1,400 signed partner integrations. Now, with all that being said, I think if it was just you and me in the bar, first of all, I think we could spend quite a few hours on some of these topics, but we're going to keep it to 45 minutes. And again, keeping to some of the salient points and trying to be helpful. Our first job is going to be to discuss the massive opportunity, like I said earlier, that the United States represents for European businesses. It's just a few stats that I looked up here before we came in. I hope they are still all fresh. The United States has a population of 330 million people, massive consumer market, obviously. It's got a GDP of $25 trillion and an e-commerce market of $1.1 trillion. Amazon alone sells over $140 billion in the US. So massive market, essentially another Europe, potentially even, according to the stats, a little bit bigger than Europe. Every day we have dozens, sometimes even hundreds of businesses who contact us looking for help in terms of understanding US taxes and the implications on their business and how we can automate. So we see, I think the first areas that we see from our perspective, mostly businesses who have already made that decision to jump into the US, and they're just asking for help, in that expansion from a tax and duty perspective. I'd love it if you could tell us a little bit more about what you see from your side at IMS, and telling us, why is it that the US is so attractive? Why do your customers choose the US?
Yeah, so our main clients are European based. So usually they start with their home market and then they look at the neighboring countries. But that potential is typically limited to some extent. So at some point they are probably looking to expand outside of Europe, and the US is one of the first countries that they're looking at. First of all, B2C. I think the US is one of the highest consumer level spending countries. So there's a huge potential for e-commerce businesses, for example. For B2B. What we see also is, for example, they're already doing business with subsidiaries, European subsidiaries of US companies, but that are typically smaller contracts. When they can penetrate the US market as well and get access to the parent companies that are based in the US, those contracts could be worth 5 or 10 times the size of a contract that they would have with those European subsidiaries. What we also sometimes see is when scale-ups, for example, are raising money in Europe, they put the US as the main market to expand. So they don't have the resources at this point to expand to the US, and they make it in their expansion plan a priority to go to the US market and use the resources that they get out of those funding to really establish themselves in the US and unlock that potential that the US market could have. But how do you see that at Avalara?
Yeah, I mean, all those things you said, we do hear a lot. I mean, there's this sentiment, I think, as you just touched on, that if you want to go to sell into American businesses and American consumers, being there certainly does help as well. I mean, some of the things that we hear a lot, certainly for e-commerce sellers, for example, a very practical point is that the de minimis threshold's really high. So any shipment going over to the US from Europe that's under $800 doesn't attract duties. So it can make it quite a sensible choice for that reason, that there's not going to be that additional duty concern on any shipments, which does make it more attractive. There's the potential language and experiential side of it. Often European businesses will either already have or find it quite easy to translate in their site and their documentation, for example, their products, instructions, things like that into English. It's not a massive language barrier. There's also a lot of very advanced infrastructure, right? So any logistics partners, security, fraud software that you're using, payments providers will also often, typically also cover the US. So not massive changes there, similar for the IT infrastructure. So it can make it very easy from that perspective. And then, all the things that we hear about it being, a very strong economy, when sales are, not necessarily going so well, for example, in Europe, they might be booming for our customers in the US. Again, that concept of there being a huge consumer market, I mean, the number of e-commerce businesses that will jump into the US pretty quickly, is quite astonishing, really. And so just to pick up on something you mentioned there, I mean, again, talking about understanding the compliance obligations in the US that a European business might have, what are some key considerations that they should take into account? Yeah. So this is it, audience. So listen carefully here. What I usually start with is the Form W8. Because that's typically how a European company gets the first time in contact with the US tax system. So you sign a customer in the US, and before you can actually receive a payment from them, they will ask you to complete a Form W8. It can be overwhelming because the form is 8 pages long, and I think the instructions 20 or 30 pages. But once you know how to complete it, it shouldn't be that difficult, especially for European countries. And why do US companies ask for that form? It's because that some payments that US companies make to foreign companies are subject to 30% withholding. And to document that 30% withholding doesn't apply, they need to have such a Form W8 on file. For example, also if you set up on Amazon, they will not ask you to complete a PDF, but they have their own type of form on their website before you can start selling on Amazon US. And another thing that we typically look at when a European company is doing business with US customers direct from the European company is on the corporate tax side whether those activities could create a permanent establishment.
Because if there is a permanent establishment in the US, it would mean that the profits that are attributable to the US could be subject to corporate tax in the US. We don't see it often that there's a permanent establishment in the US because there's double taxation treaties with most, or if not all, European countries. There's no definition of what a permanent establishment is, but the word says itself. There needs to be some kind of permanency. What is typically in most treaties included are exceptions. So what doesn't create a permanent establishment? And typical exceptions are if you just have inventory in the US to fulfill orders for your US customers. If you do some installation services in the US that lasts less than 12 months, that also doesn't create a permanent establishment. And then a last example, if you just do preparatory activities in the US, that's also typically one of the exceptions for a permanent establishment. What we frequently recommend, for example, to European companies that hold inventory in the US, is to file a protective return. To formally say that there is no permanent establishment in the US, so there is no numbers reported. There is just a specific form where you formally say we don't have a permanent establishment in the US. And the main advantage of that is that you start the statute of limitation during which the IRS, so the federal tax authorities in the US, can do an audit. The complexity usually is on the state level. Because the states in the US, they're not part of the double taxation treaties, so they have their own rules to determine when a company is subject to taxation in their state, and it applies both to US companies and non-US companies. So the rules are the same, and that's the nexus concept. I think you're very familiar with the nexus concept, so maybe you can explain a bit what the nexus means and what the typical examples are of what could create a taxable presence in a state.
Yes, sure. Yeah, I'm happy to take that one. So, and you were just talking there about the W8, and so these are things, like you said, that you need to get done at the federal level. So W8, permanent establishment, protective returns, filings with the IRS at the federal level. Whereas Nexus, like you say, and I'm happy to explain this, at the state level and even sometimes in local jurisdictional level within the states, is essentially the connection that businesses might have with those taxing authorities. And some of the things that can trigger Nexus would be holding stock, right? So, you said that it doesn't apply to permanent establishment, but for for determining whether or not you have Nexus, holding stock does trigger it in every single state and jurisdiction almost. I can't think of any, in fact, that don't. Then it might be other things, having any agents or even any, temporary staff that would be traveling into that state for business reasons can often trigger Nexus. Then there's an additional concept, which is the concept of economic Nexus, which unrelated to your physical activities, which would be, any, again, physical offices, warehouses, inventory, any trade shows that you visit in person, if you have any employees visiting that state. Economic Nexus was brought in by what's called the Wayfair ruling in 2018, and essentially was a ruling that went to Supreme Court to give states the permission to levy sales taxes on foreign businesses that have no physical link to that state. So ever since 2018, gradually, but now today, every single state has an economic nexus threshold. Now, again, the challenge is that every single state varies. And so what one state might define physical nexus as might vary in another state. And same thing with economic nexus. Those thresholds vary drastically. So it might be $100,000 of annual sales into one state, or 200 orders, which catches out a lot of small businesses as well, ranging up to some of the bigger states. Thankfully, have got bigger thresholds, like the state of New York. You say that you have to sell $500,000 of sales and 250 orders, so there's the and rule that applies there, before you have to register. But the key thing is that as opposed to VAT, sales tax is always due on the final transaction where the good will be or service will be consumed, and Nexus is making you the agent of the state.
Yeah.
So the reason why it's super important is because if you fail to notice that you have Nexus, the state will hold you liable for all of the taxes and all of the obligations for every order that you're making once you've hit Nexus.
I think what you said, indeed, I think it's important to stress that there's no VAT in the US. It's called sales tax. It's always added on top of the sales price, and you need to check whether it's from a US company or a European company, whether you are responsible to collect that. And you explained it very well. When a European company can be responsible for collecting sales tax in the US.
Yeah, and it applies to everyone. It applies to every business, regardless of whether or not you're in the US or outside of the US. And this leads to a question that we get quite a lot. And I'd love for you to explain if you can. I mean, how would anybody find out that their company has Nexus or should be registered? What do the departments of revenue do? I mean, how does that work? I'm sure you get that a lot as well.
Yeah, indeed. What we see more and more now is it's not really the states that are questioning the activities. Sometimes it can be the case. But how it might come up as well is you're raising money in the US, or you're planning to sell your business, your European business, sorry. And there will be a due diligence. There will be financial due diligence, legal due diligence, also tax due diligence. And if their advisors are seeing that you're actually doing a lot of business in the US, they might also question whether you're registered to collect the sales tax, what the potential liability could be there. I've seen it a few times that the buyer was trying to bring the sales price down. Because they flagged the sales tax in the US as a potential liability. Another example where the states, I think it went quite far, is in Massachusetts. It was a few years ago where they actually asked Amazon to give a list of all the Amazon customers that hold stock in the Amazon warehouses, give an idea of what the value of that inventory was. And then they started to question whether those companies were actually registered in the state for tax purposes, whether they were filing returns. And how they might also find you is if you as the seller, you don't charge the sales tax on the invoices. It's in principle your customer that has to self-remit use tax to the state. But everyone is not so friendly towards the state, so there are not a lot of companies that are voluntarily remitting the use tax to the state. But there could be use tax audits at your US clients where they check some purchase invoices, they see the name of your company. There's no sales tax charge on the invoice, and they might look further into whether your company is registered and filing sales tax returns in that state. That I think that those are three of the common things that I see. How a European company might get in touch or flagged that there could be a risk for sales tax or state tax in general in the US.
Yeah, it reminds me of a few stories that. Always where we're trying to, help businesses as much as possible reduce this tax liability, and often partnering with yourselves to do so. One customer came to us having just sold his business for $5 million. Once he had sold his business, it turned out that in due diligence, he had $1.6 million of tax liability owed over the course of the years. So he had to pay that out of the money that he had just received for his company. So it can be quite painful. And obviously, one of the reasons why we always say, automate it, get it done when you start selling, rather than waiting for it to become a problem.
Yeah, exactly. You can always try to, if you don't charge the tax on the invoice, you can always try to reclaim it later from your customer, but maybe they already paid it to the state. It's usually much more difficult to do it after you issue
Yeah.
the invoice already than just doing it right.
Yeah,
from the
and
start.
in saying that Massachusetts got a list of Amazon customers
Yeah.
to work through.
Yeah.
Wow. Okay. Some of them can be. Some of the states can be quite aggressive.
Yeah.
We've heard of Florida also going back a very long time historically to Amazon sellers to
Okay.
try and recuperate some taxes.
Okay.
Yeah, I think, and you know, so I'm going to touch upon, you know, what our customers do with us, and essentially what businesses need to do once they're registered. So we've looked at Nexus. Well, we've looked at, you know, permanent establishment and what you need to do with the IRS. If you have Nexus in a state, then what happens? You register within the state, and this is what we automate and what we help customers with is making sure that you are collecting those taxes, and we do that by integrating with business systems to make sure that the taxes are collected accurately. Now, the challenge there is that there are over 13,000 tax jurisdictions in the US, and guess what? They change their rates and their rules and their definitions all the time. Last year alone, we saw over 150,000 changes to rates and rules in the US alone. And in addition to that, there's the whole concept of product taxability and exemptions in the US, which means that not every product is going to be taxable and carry the same rate in every state. So this is why Avalara started and exists in the first place, is to be that tax engine, to collect and to automate the tax calculation on all those jurisdictions, which we can do automatically within the business systems, but then also helping filing and helping manage any compliance documentation. So another key thing that catches out a lot of European businesses is exemptions for customer types. So very often this will be a resale exemption, but there are many different types of exemptions that exist. If you're selling to governments or hospitals or charitable institutions, sometimes religious institutions in some states, Native American reserves, Native American populations can also have exemptions that apply. Again, going back to this concept of the liability and the responsibility being owned by the seller, the seller has to collect documents to prove that that sale is exempt. So we help collect. Once you're registered, you need to make sure that you're collecting the right taxes in the right jurisdictions, that you are filing them to the authorities, and that if any exempt sales are there, that you have proof of the reason why it's exempt with those customers. Which brings me to a question, again, that we get a lot from our customers, especially the European ones, who ask us, you know, if I'm adding sales tax to my orders, is this going to be a disadvantage to me as a business? What do you think of that?
We had a few e-commerce companies when they started to sell into the US. They always put including sales tax on their listing on their website, which means that it impacts their margin. They get less money because typically in the US you list your sales price, and when you go to the checkout, the tax is added on top of the sales price. So it doesn't impact your margin. You're responsible to collect the tax and remit it to the state. So for a few e-commerce companies, we flagged that. They turned inclusive tax off for the US. They were actually afraid that it would impact their sales in the US, but actually it wasn't the case. So it for some it even increased because, in the US they're used to paying sales tax. They are used to that it's added on top of the sales price when you check out. So I don't think it's a disadvantage. It shows you more that you're adopting to the US market, because that's also how US companies are doing it. They add the sales tax every time when you go to the checkout. So I'm not seeing it as a disadvantage, and you're putting yourself also in compliance with how it should be done.
Yeah, and that's a really interesting point. It's amazing to hear that you've had that direct experience, and we should ask some of our customers as well of what happens once you turn sales tax on. Is there a dip in sales or not? So it's great to hear that there hasn't been for those examples and for those reasons. And I mean, I think a thing that I'd point out here is that there are 18 states, if I recall correctly, that have notification obligations and requirements that they impose on sellers. So one of them being Washington, where Avalara was founded, they go down to the level of specifying the wording that needs to be used to state the reason why you are not collecting sales tax on that order. And if you are collecting sales tax, they prohibit tax-inclusive pricing, which means that you have to transparently show it at checkout, on invoices, and again, the state of Washington specifically has wording that they say you need to use on your website or on your customer invoices to stipulate why you're not collecting it. And again, if it goes to the point that you don't have nexus yet in that state, again, these states will say that you need to be clear to the customer, and you might need to send them an audit email at the end of each calendar year to tell them and to remind them that you have not added sales tax to that order, because, again, the customer technically still owes that tax. It's just the responsibility of the customer because you don't have nexus yet. So in reality, and this is, I think, what a lot of our customers choose to do, they're very happy to add those sales taxes because the practical implication of adding the correct messaging and wording on your invoices and on your receipts and in your checkout of saying, I do not have nexus in the state of Washington, and therefore it is your responsibility to self-remit these taxes, in itself is quite challenging.
No, indeed, the administrative burden with the compliance, the notification requirements are usually higher than just registering and collecting the tax.
I mean, I do like to think of how a state enforces this, how they uncover it. I mean, sometimes I like to think of an auditor going and buying from a bunch of European businesses and just seeing if they send him an email after 12 months to remind him that he owes taxes. Another one that we get questions around quite a lot in this area are marketplace legislation. And, I think one thing to clarify here, and I'd love to hear your comments on this if you do have any, we get customers who are selling on Amazon only, or on marketplaces only, or maybe on a marketplace and they have their own e-commerce website and they ask us what the difference is. I think, this is a really useful point to be clear about, going back to what we talked about on the inventory side of things. Whilst selling on Amazon and having inventory in their warehouses may not trigger permanent establishment, it might trigger physical nexus. Now, the good news is that marketplace legislation has been enacted in almost every state. There are 5 that don't have specific legislation around it yet. And most of the states, all of those states impose the obligation on the marketplace to collect and remit sales. Now, they're doing this because the states are going to find it very difficult to go after that $140 billion worth of sales to Amazon, all of those sellers that are on Amazon, to ask every single seller to remit and collect sales and monitor and track it. So the reason why the marketplace legislation, marketplace facilitator legislation was enacted and was so popular with the states is that it gives them a single point for collection of sales taxes from the marketplaces, which is great. So good news is if you're selling only on a marketplace, you don't have to collect and remit those sales taxes yourself. However, again, a lot of the states since then have been very clear that they do still want visibility of the of your total sales revenue that you're making and what the marketplaces are remitting. So they will still say, even though you're only selling on marketplaces, you still have to register with us. We might even have a special quarterly $0 filing for you to complete, but they will be $0 returns. We still want you to do it anyway.
I think you said it right. If you're only selling on marketplaces, typically those marketplaces are collecting the tax for you, and they remit it to the state. There are some companies that are only selling on marketplaces, but typically they also have their own websites in addition to the marketplaces, and then it can get tricky, especially with the economic thresholds, because some states, they say you need to take all sales into account, so also the Amazon marketplace sales. Others, they say you can exclude the marketplace sales to calculate the threshold when you're required to collect tax in our state. And even if you exceed the threshold, some states they might say, okay, even if you exceed the threshold, if you're only selling on marketplaces, maybe there is no registration requirement and filing requirement. But yeah, unfortunately, it's not very streamlined, and every state still has its own rules, and there can be small differences between each state.
Yeah, I mean, I think the states are trying to retain control and transparency. They want to see what's going on. For most states, sales tax represents over 50% of their revenue, of their budget. Very different from Europe, which tends to be more around the 20% or 20 or 30% of a European country's budget is made up from VAT. So it's important for them to at least see what's going on, which I believe is why they do it.
Yeah. Maybe if I can just add to that, for the companies that are only selling on marketplaces, there might be no sales tax liability, but there might be an income tax liability. Especially, I think there are 5 states that have a gross receipts tax. For example, Washington.
Yeah.
That if you're making sales in those states, there you might not be required to pay sales tax if it's only on marketplaces, but there might, I think it's 0.5% or something, gross receipts tax that you need to pay on the sales that you make into the state. So yeah, you need to look at each tax type as well. So there could be sales tax, gross receipts tax, corporate income tax, depending on the activity in each state and what they have.
So if you're selling on a marketplace, it's maybe a little bit easier, but there's still some administrative stuff to do. Whereas if you're selling directly, again, the key concept being that the responsibility is yours as a seller.
Exactly.
There's no marketplace facilitator in this case, which the state will go after. It'll be your own responsibility. So this brings us to, I think one of our last topics, and a really important one, and one that we get asked a lot, and I love passing over to you guys at IMS. Why would a company choose to incorporate and set themselves up in the US?
I think there can be different reasons. If we're starting with sales tax or tax in general, some European companies, they don't want to have the liability on the European company. So for the US operations, they put a US subsidiary in between that is acting as a distributor of the European parent company, meaning that it's the US company, the US subsidiary, that is registering in the states where they need to collect the sales tax, that is filing corporate income tax returns in the US. And that way the European parent company is protected from the US tax system. So it would be more difficult if in case there would be a liability to go directly to the European parent company. Another reason could be credibility. If you want to show that you mean it seriously with the US market, you might want to establish yourself as just a US company like other US competitors. And what we also typically see is if you're hiring people in the US, then it's typically better to have a US company that the payroll is run through that US company, again for liability reasons, not only tax but also legal and corporate liability.
Really good points there. Thank you for explaining that. So I think that covers off a lot of the topics we want to talk about. I don't think we've missed anything. I think just on that, and again that area of incorporation and what advice on what to do as a business. Being firmly part of IMS's services. I'd love to hear a little bit more, and I think the audience would love to hear a little bit more about specifically how IMS can help them.
Okay. So how we typically start is a review of the US operations. If you're selling direct from Europe to the US, we look at what I just explained. Is there a permanent establishment in the US? If not, should we file a protective return to protect the European company? Nexus in States, both for corporate income tax as well as for sales tax. We can help as well with when there is a US company. We can assist with the bookkeeping of the US company. We can assist with the corporate tax filings of the US company, the state tax filings. We can advise about transfer pricing for transactions between European companies and the US subsidiary. And we can also advise about sales tax, depending on what the activities are. If there are a lot of transactions, there's probably no choice but to automate. So then we typically work together with Avalara to help setting up the system, look at the states where they are required to register, look at the tax codes, which determine taxability of the products that the company is selling. And then we check with both with Avalara and with the company how far they want to go with their automation. If it's just maybe 1 or 2 states, they prefer that it's IMS that takes care of the sales tax filings. If it's 10 or 20 states, it might be more complex, and then it might be better to just automate the whole sales tax process, so both registration, collection, and filings and remittance in the States.
Great. Thank you. I'll say a little bit about Avalara then. So we provide solutions and software. So it's the automation aspect of all of this. HS classifications of goods, registration and licensing software with the authorities, tax and duty calculation and determination. So to get the correct tax and duties in checkout or on those invoices, any filing, e-invoicing, live reporting, connections to government portals and things like that. And finally, also that compliance document management piece for automating collection of those exemption certificates. And again, all of that being integrated directly into the business systems with our 14,000 plus signed partner integrations. One of the great things is that there's typically very little coding or development work to be done.
Okay.
I think one other thing to point out for everybody here, and as you know very well, we have got a very strong relationship with the states, and we can leverage plenty of programs of voluntary disclosure, amnesty, and the streamlined sales tax program to help make sure that companies are again, getting low-cost tax compliance as much as possible.
I think that's indeed one of the good programs that you have in place. I think you're one of the only tax automation providers that are SST certified, where the states basically cover the cost of registering and filing.
Yeah.
So especially for e-commerce businesses, they might reach the 200 transaction thresholds very quickly. Or even the 100,000 sales threshold. So it can get very expensive if you need to register in 30 or more states. So if the majority of those states would cover the cost of registering and filing, I think that's a very big advantage to work with Avalara.
It is, and one of the major advantages that I always put forward to our customers of the streamlined sales tax program isn't even necessarily that. It's the fact that there is a audit amnesty for the first year under the program within those 25 states. And following that, there's audit protection, which means that the states come directly to Avalara to conduct a sales tax audit. Oh, wow. And I'm sure you know how painful audits can be. Yeah. This is a huge burden taken away from customers. Yeah. It's a very popular program. And even though, and again, just a reminder of how we work with IMS, even though we do try and simplify things as much as possible and automate as much as possible, software is not magic, and we work a lot with IMS to make sure that everything is that essentially you're automating the right things and that it's set up correctly. So yeah, we do thank you for that.
No, we're very happy to work with you. Some companies, they start selling in the US and they're used to the European system where there are not that many VAT rates, but then they come into the US tax system where you, as you explained, you have more than 10,000 different rates. So if it's just a few transactions, it might be manageable to do that manually. But if you have even just more than 100 transactions, then you probably need to automate, and Avalara is a very good solution for that.
Oh, thank you. So that brings us to a close of those topics. So thank you for viewing the webinar. I think we're going to check if we have any questions. Producer, if we could get any comments or questions on the screen, thank you. So let's take a look at some of these. And I've got them here as well. So we've got a few questions.
I think the SaaS question is a good one.
Yeah, let's that one. So if I only sell business to business SaaS, do I still need to register? I'm going to translate some of these questions that we've got in the Q&A. Yeah, if I only sell business to business SaaS, do I still need to register? Ben, what do you think?
In the US, the concept of B2C and B2B, it doesn't really exist. If it's the end user that is typically paying sales tax. So if you're selling to a business that is going to use your software, your SaaS product, they might be required to collect sales tax. But again, taxability, I think, is also an important aspect here. Because typically physical goods are subject to sales tax. Most services are exempt, and I think software is a bit in between, especially SaaS, where half of the states, they say SaaS is subject to sales tax and the other half not. So first thing to check is, do you have nexus in the state? Second thing to check is my product taxable? And then third thing is my customer exempt or not, whether it's B2C or B2B.
Yeah, perfect. And I think just to add to that, I think where this question is coming from is the concept that if you're selling under a VAT regime, business-to-business software is more often than not going to have a reverse charge mechanism applied. So you'll zero rate it, add an invoice message to state why your customer's going to self-declare that VAT. Whereas in the US, there's no concept of that. So in the US, again, because everything because sales tax will apply to every order. Yes, all of those obligations that we just talked about earlier, the nexus requirements, those triggers, and everything that Ben just mentioned in terms of the exemptions and calculation product taxability requirements do apply. But yeah, there's it's not like under the EU VAT regime at all.
Yeah.
There's an obligation to register.
So if you're selling SaaS, whether it's B2C or B2B, there could be potential sales tax obligations in the US.
Yeah. Perfect. Should we just have a look at some of these? So we've got questions on the iPad and comments on the screen. So I think this is for Avalara. Do we have, from Guillermo, do we have integrations with e-commerce solutions such as Shopify? Shopify is one of those 14,000. Yes, absolutely. No development work there. And Guillermo had another part. Do you work on B2B, B2C e-commerce businesses? Yes, we are a marketplace. Would like to have part of our stack. Let me just read that. So yes, Guillermo, that sounds about right. If you're not selling in the US yet, then none of the thresholds will apply. But if you get stock in the US, you'll have to register as soon as possible. The states would expect you to register from the point at which your stock essentially lands on the soil.
I think the other question about do you recommend we take sales tax straight away, even if Nexus isn't reached? I think that's more of a business decision. What we sometimes see is you get a first order for 150K. And in principle, on the first order, you don't need to collect sales tax. It's only as of the next transaction. But if you know that you're going to do more business in that state or the same customer, it might just be easier to just register as of the first transaction. It's also easier to explain to that existing customer that you're charging sales tax straight away than to say on the first order we didn't charge sales tax, but then on the second order we will do it. The states, they also, I think, they try to promote it. They explain it as a courtesy towards your customers, so that they don't have to pay the use tax themselves to the state. Yeah, I think that's a nice way to say it. I think it's more a business decision. Whether you want to register straight away or not.
Yeah. And so just to pick that, from our perspective, Christina, I think what we see, businesses doing, it really depends on the type of business that you have, your expectations for growth and scale. Mm-hmm. It wouldn't be unheard of for a high growth, high scale, well-funded business to register in all states where it's taxable straight away. Because if they're expecting to breach all thresholds and hit Nexus everywhere in their first year, then simply the burden of registering in each state every time, monitoring Nexus thresholds and stuff like that, can be seen as a bit of a pain. Certainly from bigger businesses that might have a divisional startup or something like that that's going to be well funded. They know they're going to grow very quickly. We see a lot from US companies that are starting up a new company and say, I've been through this before. I just can't be bothered to keep track and register everywhere. If you guys are going to automate everything, then we might as well just do it all in one go. And again, thanks to certain programs and kind of the way the software works, it can be pretty cost effective, but it depends on the business.
Yeah, indeed. Sometimes it might be indeed a bit too much to register straight away in all the states. I think also a nice thing with Avalara is that you have a good Nexus tracker where it tracks the sales and the thresholds. You will get a notification even if you reach 80% of the sales.
Exactly.
So you can plan ahead, and it might not be necessary unless you're absolutely sure that you will reach the threshold in the next month. Otherwise,
Absolutely.
You can just monitor and
absolutely. What else do we have in here? Is there a treaty on income taxes to avoid double taxation, or is the treaty only for sales taxes?
So there is a double taxation treaty with most, if not all, European countries. With the UK, Belgium, France, all those countries have a double taxation treaty. But it's for income taxes, and it only applies at the federal level. So the treaty doesn't impact state taxes such as sales tax. Those rules are really determined by the state, and the treaty doesn't impact that.
Yeah. And in fact, what there will be in the treaty, for anybody thinking about it, there'll generally be stipulations for how the authorities collaborate together to ensure that there's no tax evasion, for example. So the treaties will generally include stipends to say, if there is a UK business that has got liabilities and not resolving it in the US, that treaty will have something in there to say, yeah, we're going to let the US come and pursue that in the UK. Can we scroll up a little bit, please? I think there are some other comments, some other questions in the comments there that might be interesting. Okay, B2C SaaS services. So that first one, Matthias Shapiro. So B2C SaaS services, I think the answer is the same for B2B SaaS services that we talked about earlier. So in the US, the concept of B2C or B2B doesn't really make a difference. So yeah, you're mentioning the VAT digital services. VAT for SaaS companies digital services regime. Yeah, but in the US, like I said, yeah, it's not going to make a difference. B2C is going to be treated as anything. The interesting thing about SaaS is that I think there's something like 25 or 26 states that tax it anyway. So it's not widely taxable everywhere. Certainly, if you even try and register in the state of California and all you do is SaaS, they're going to reject your application, basically. So we don't want to see your filings. We don't want to see your business. We're never going to tax software and services. We'll probably make a few very big enemies in our state if we did. But yeah, by and large, in those other 25, 26 states where it's taxable, then yeah, the rules are going to apply as with any other business, whether or not you're selling goods or services. And then, yeah, the B2B SaaS, so I think I answered that. I mean, again, if anybody wants to join us for our 3-hour deep dive at the bar later, you can always ping us a message and come join us. We're in London today. We can answer more questions. But on a serious note, you do have our details. So if you'd like to reach out to us on LinkedIn or otherwise, then you can ask some of these questions afterwards. I think we've covered most ones. I can't see any other comments. Or any other questions here? I think we're pretty much at time. So I think that's a wrap, Ben. Thank you very much. It's been
it was
a really
very
good session.
Interesting. Thanks again for inviting me.
I always love learning about taxes. And yeah, we hope it's been really useful for everybody in the audience. Thank you for joining us today.